with me on the panel today are Mr. Jerry Kalogiratos from Capital Products Partners, and also Mr. John Costain from KNOP Offshore Partners. And so before I get started with some of the topics to discuss, I was hoping that that both Jerry and John could take a couple minutes to tell you guys who they are and a little bit about their company. So Jerry, can you get us started?
Sure, thank you, Doug. Capital Product Partners is a diversified maritime MLP. Our fleet comprises 35 ships, that's 20 product tankers, 10 containers, 4 Suezmax tankers, and 1 odd dry bulk vessel. We have a remaining charter duration of around 6 years, and we have been able to leverage if you want, the relationship and the capacity of our sponsor and manager to do long-term business with end users, be it oil majors, commodity traders, and liners, in order to put together CPLP, which, while it is active in the more traditional shipping segments, it has put together an MLP with good charter duration. I think it is also important to say that we have grown the business by quite a bit. We started in 2007, our IPO with 300,000 deadweight of product tanker capacity. Today, our fleet capacity is 2.6 million deadweight, and as I said earlier on, it's a diversified fleet which has across the 3 segments, tankers, containers, and dry bulk, and all with long-term charters attached.
Thank you, John.
Hi, yes, we're not Offshore Partners. Has 10 vessels. It's specifically a shuttle tanker business. Different sizes of ships, mostly Suezmax and Aframax class. Basically, these tankers are what we call a mobile pipeline business, taking the crude oil from the asset to shore side. The vessels are field specific, but that's not to say we don't design them so they can be run on different fields. But basically, they're basically designed at the time 2 years before the field comes on stream, and therefore basically they stay on that field generally throughout its life. And that's how we know that we basically have a situation where the actual contract is a significantly longer period than the paper might indicate. They're strategically vital assets, and it's a niche space. Our competitor and ourselves are both structured as MLPs in the US capital market, so that should tell you everything about the fact that it is a stable long-term revenue stream. So basically, we came to the market in 2013, and since then we've increased the distribution by nearly 50% to 52 cents a unit. Today we're operating on an 11% return. The play is that in Brazil, the pre-salt fields are basically increasing production quite rapidly. In 2014, the pre-salt was generating about 500,000 barrels of oil per day. Today, the equivalent production is at 1 million barrels, and it's expected to continue to grow at this level. Shell merged with BG partially because of the Brazilian oil reserves, and this is basically what our play is. Going forward, we expect the market to expand significantly. I think the next 2 to 3 years, we'll probably see a fairly static market in terms of shuttle tankers, although we have 4 ships on order out of a total of 8 in the world fleet. The world fleet today is about 77 ships. So going forward, it looks very interesting. Fearnleys project about another 40 shuttle tankers in the next until 2020. We think that might be a little bit optimistic, but genuinely we do feel there'll be a substantial increase in the number of tankers required in the next 4 to 5 years. With the Libra field alone coming on as well as a separate development, that requires 12 to 15 shuttles. So we expect a significant increase in the size of the business. Today, the MLP has about a market cap of about $500 million and a yield of about 11%. We anticipate a substantial improvement in the size of the MLP and also the yield over time, provided things develop. Today, obviously, we're at a yield discount to a lot of the Illyrian index is about 7 to 8% yield. So we would hope that as the business expands and we continue to perform in line, you know, we expect a significant improvement in the outlook for the MLP. I think that's about.
Great. Thank you very much, guys. So as you guys heard, you know, very distinctly different businesses that each of our panelists operate within, but yet we're all here on the same panel discussing yield. So within that context, my first question for you guys, and just, you know, keeping it conversational, is since you guys each operate in distinctly different businesses, can you guys describe the attributes of your sector that are conducive for yield-oriented instruments as well as yield-oriented investors, and you know, kind of what about your business, you know, makes it suitable for yield? So Jerry, if you wanted to get us started.
Sure. We started as a product tanker business, and at the time we started with 8 MR product tankers back in 2007 and another 7 to come, all with long-term charters between 3 to 10 years. As we evolved and always relying on the strength of and our ability to do business with end users. At the same time, we found out that the period market for product tankers has not always been very liquid at the, if you want, the longer end. So over the years, we have added new assets. We have added container assets and one odd dry bulk vessel, which have given, if you want, charter duration. So they give us an underlying cash flow. And on top of that, we have also the expirations of the product tankers. So in a way, while you see a diversified fleet, the mix of our charter expirations is weighed more heavily on the tanker space, be it the products or the 4 Suezmaxes that we own. So in a nutshell, if you want, while we have short-term exposure on the product tanker space, we rely also on the sustainability of the distribution going forward on the back of the longer-term charters that many of our containers provide. At the same time, and I think that's also a very important aspect of the business, is that at times that we do think that the product tanker market is improving, and on the back of this you find that there are also opportunities to fix long-term business on the product tanker side. We will go a little longer on the products as well. So really it is a balancing act between finding assets with long-term charters, but at the same time managing the exposure on the tanker side, depending on our expectations for these two segments.
Gotcha. John, about the shuttle tanker business, I mean, what aspect of it makes the yield the right vehicle?
Well, it's basically a strategic asset. It is like a pipeline business. That's why it's a good fit with the MLP space. There isn't an S&P market in shuttles. Basically, you design a shuttle to stay within a field for 15 to 20 years. We've got a lot of experience in building shuttles, so basically we do build them so they are transferable to other fields. So we're not totally locked into a particular space. But with them being late cycle as well and specialist, it's not easy to substitute them once they're built. So basically, it's difficult for a competitor to move in without you having clear signals from the charterer. So there's little upside or downside risk on the counterparty, because the counterparty is the end user of the steel. He's the guy who owns the oil. Now, a lot of shipping companies that charter ships out, they'll charter to third parties or people who are reusing the asset to find cargoes. Well, obviously with a shuttle, it is basically we only contract with someone with a need, i.e. an oil major or a national oil company. So our contracts pretty much are AAA rated, I would say. In terms of shipping, they're gilt plated. And then at the end of the contract, say 5 to 10 years, because of the way the contract is costed, and without an S&P market, a fairly stable flat market, you will see a renewal at a sensible rate, which is more or less in line with what the original rate was. Obviously, we are impacted a little bit by the movement in capital price of the ships, either up or down, because we have to be mindful of any substitution risk, but it's fairly minimal. So you can see that with a decent amount of leverage as well, it's quite easy to leverage these ships because of the quality of the charterer and the fact that the charters are long-term and the fact that traditionally there hasn't been a lot of substitution risk at the end of the contracts, that these ships do run that they run as a very good investment vehicle and they produce stable long-term yields.
That's very helpful. Thank you. And then, I heard each of you discuss this topic, but I'd like for you to elaborate on it a bit. And Jerry, you talked about, the need to balance kind of, sustainable revenues with also kind of your view as far as how the market is going to evolve. So how do you do that in terms of, I have to have a certain amount of cash coming in, but at the same time, I want the ability to capture maybe an improving market. So how do you balance your employment strategy? And then also, does it make sense to say, okay, well, this type of ship I want on a contract versus this type I want on, a shorter term contract? So logistically, how do you balance those competing needs?
Well, the first and foremost consideration is cash flow visibility and distribution sustainability. You have to look at your cash flow going forward, and within, if you want, the limits of the segments that you're active in, organize or rather fix your cash flows in a way that underpins the distribution sustainability. So that's, if you want, the first and most important criterion. But at the same time, as we discussed, different segments that we are in have different, are more liquid when it comes to contracts on different lengths. For example, the product tanker market on average would be more liquid on the 1 to 3 year charter contract, while on the container side, it's easier to find 3 to 5 or even longer charters. So you have to take that into account as well. The third criterion is staggering expirations. You don't want to bundle. We own 35 ships. As I said, 20 are product tankers with shorter or longer charters. You don't want to bundle everything so that they mature at the same time. You want to diversify so that in case your expectations with regard to the market are not do not prove right, or a recovery is delayed, you don't want everything to come off at the same time. And these are really the three criteria. Then, if you add to this a bit of charter market expectations management, I think the way that this works is that we will try to go shorter, like, for example, we would do today when the fundamentals of a specific segment, like the product tanker market, are good in the medium to long term, but there is a weakness in the short term. So in such instances, we will try to go shorter than longer. But when markets recover, when we see a decent and liquid period market, we will try to fix longer charters. So we're not really in the game of timing or maximizing the exposure to specific market. Distribution sustainability, cash flow visibility is what is very important, but you have to take into account your specific segments.
John, do you have anything to add?
Well, basically, with shuttle tankers, we don't actually contract unless we've got a contract. So there has been no speculative ordering of shuttle tankers, so it's not like a general shipping business. So basically, we have at least 5 to 10 years covered before we'll even place an order. And that's, that basically underpins the quality of the business. Looking at it generally, the outlook for the industry is very, very positive. I mean, today we have 77 ships. We expect in the next 10 years another 50 vessels. In total, we'll probably see about 120 shuttles at the peak, I would guess, depending on what happens in Brazil. I mean, looking at Brazil, generally, today Petrobras have doubled the production in the last 2 years. They estimate to bring the oil up to sea level, it's about $8 a barrel. So the quality and the cheapness of the oil off that field is very high. And Statoil have recently bought a license for operating that field. Shell, BG have merged because of these fields, partially because of these fields. And Petrobras, if you read their press releases, you will see that the production has improved dramatically. 52 wells are producing 1 million barrels of oil from that area. So we are very bullish about the outlook for this industry. We're also very bullish about the growth volumes for the number of tankers. And we don't see, this is another reason why we don't see a lot of substitution risk. And we consider ourselves as Knutsen to be the premier operator of shuttle tankers, having developed the concept over 30 years ago and grown the company organically over that time. Unlike our major competitor, who basically is a decent operator, but he has acquired assets through mergers and acquisitions a lot of the time. So we think we've got a lot of expertise here, and we think we can be a market leader in this field.
Excellent, thank you. And then when you guys are talking with some of your constituents, whether it's investors or bankers or whomever, how important is the underlying business to them? I mean, do they care if you're in the products market or the shuttle tanker market, or are they more concerned with just kind of what we've been talking about, kind of the secured revenue, the secured cash flow? So does the business that you're in enter the equation? Is it as important as kind of the business that you built in terms of the secured revenue? So how do you find those conversations and where people tend to put more emphasis?
Well, from our side, definitely the discussion revolves around the distribution, cash flows, sustainability, visibility, and all that. But given the fact that our remaining charter duration is 6 years, but it also masks the fact that we have certain charters that are 12 years long, or about 10 now, but we also have a few charter expirations coming on over the next few months. It is always important for investors to understand the underlying business, especially on the product and Suezmax tanker side, and our expectations with regard to charter renewals. So it is, given the structure of our charters, and it's an integral part of any discussion.
Gotcha. Same for you, John?
Well, we basically have been in the business 30 years. We generally contract with national oil companies or the oil majors. So we do see we can leverage the vessels pretty highly, actually, because having the quality of counterparty that we do have, and the long-term nature of the business, and the fact that the vessels are specifically on the fields, we generally do leverage up to quite a high level in the sponsor, and the MLP is capable of leveraging. I mean, today Petrobras probably is a little bit weak as a counterparty in terms of financing, because, but that's a perception risk rather than reality, because today the structure on our contracts they're not at risk. Petrobras is a very, very good counterparty, a first-class charterer. The problem around that company has been that it has had a lot of OSVs with blocking and trapping rights effectively, and they've been able to redeliver a lot of ships, as have Shell in the Gulf of Mexico, but that's not so heavily reported. But generally, we've seen with Petrobras that they've been a first-class charterer, and they've dried up 2 of our ships in the last 6 months, and they'll be dry docking a couple more, putting them through the first special survey. So we generally have a very good relationship with our banking syndicates, and we have no problem with refinancing.
Thank you. And then maybe shifting gears a bit in terms of, legal structure. When you look back at some of the shipping equities, going back 10, 15 years, what have you, yield has been a component of a lot of the more successful stories, whether it's Frontline or whatever, back 2002, 2005, what have you. But, the MLPs became a bigger part of the publicly investable space, over the last, 5, 7 years, something like that. So from your perspective, what are the advantages, what are the disadvantages in the MLP structure versus your traditional C Corp that just happens to have a yield?
Well, traditionally, MLPs, including maritime MLPs, have been valued against the yield, and then you had certain elements to that. It was sustainability of the distribution, how well it is underpinned by the contracts, as well as the growth element. Until maybe year and a half ago, the growth potential was very important. You saw that the best trading MLPs were the ones that could provide a growth trajectory to the distribution. And they could show that with assets to be dropped down from the sponsor or the open market. I think what we saw over the last few quarters with energy markets getting very volatile on the back of the lower oil price environment is that the premise that capital markets are always open for MLPs to raise money, be it on the credit side or the equity side, to effect those drop downs has been shattered. So we saw many MLPs, be it definitely upstream, but also midstream as well as maritime MLPs, suffer, and the equity valuation changed. I think today distribution and distribution sustainability is continues to be very important, and that is an advantage as it has often provided companies with a better equity valuation than your traditional C Corps. But maybe the growth potential of the distribution is less important, and the balance sheet, people emphasize more the balance sheet. We have been fortunate enough to have one of the better balance sheets out there with today net debt to cap of 33%, which gives us a lot of leeway in what we can do and how we can do it going forward. And I think that until we see a full recovery of MLP markets, that will remain one of the bigger elements when it comes to valuation of MLPs. But for me, if you ask me, in the end, as a company, what is the biggest advantage of being an MLP? It's simply the discipline. We don't order vessels on spec. We don't speculate in the spot market. We always make sure that we have charter coverage. We always make sure that we have how we can progress and what this means for the distribution. And I think that imposes a discipline on you and the company that sometimes is lacking to let's say, spot C Corps.
John, I saw you nodding a lot.
Yeah, I do agree with him. I think that's very true what Jerry's saying. I think it is a discipline, the MLP, and it causes companies to think about what they're investing and how they invest it, and it is a payout vehicle. So at the end of the day, you have to achieve the returns that required under the MLP. I mean, we've seen a lot of C Corps today. They're trading significant discounts to MLPs actually. If you compare the tanker companies that. I mean, I'm not talking about our tanker company because it's a bit different, but there are general MLPs and there are tanker companies, and the tanker companies are trading in the C Corp environment at a significant discount. And I think that's partly to do with the fact that they don't have the discipline of the MLPs. I also think the MLP market, one of the big positives it's brought a new suite of investors into the shipping industry, because a lot of these MLP funds are for retirement, basically incomes for pensioners, I guess. And these areas haven't been tapped before for the shipping market. So actually the MLP is pretty effective on that level. I think genuinely it is a strong discipline for the sponsor and for the MLP itself, and that can have been lacking in the general bigger shipping market. I think with us, with being very niche and with no real S&P market there, because it is not that sort of market. It's not that important that we need to be a C Corp where we can trade assets. We just basically want to trade the assets out throughout their lives and then scrap them, and that's how the market's always operated. So it actually is a good fit for the MLP. The fact that we are a pipeline business and the fact that we don't have an S&P market, the fact that we contracting ships at, and without speculation, all these things mean that we do actually have a very good fit to being an MLP. It's just a little bit disappointing that our yields are so high, really.
Gotcha. And John, you alluded to the next question that I had. And so, Jerry, I'll ask you, because I'm assuming the answer is yes for you, John. But being structured as an MLP versus a C Corp, I mean, do you find yourself talking to a new class of investor, guys that haven't traditionally looked at shipping, back from, if you remember the crude carrier days, CRU versus CPLP? I mean, are the CPLP guys different than the CRU guys were?
Definitely, the audience is different. They're fans that focus only on MLP or be it maritime or midstream MLPs, and they have been, if you want, a part of our shareholdings for a long time. So if you want, yes, you in a way, you're right. The MLP structure does allow you to tap other sources of capital, and I think it has been also the case when C corps, in a way, are less attractive to the general investment community. So yes, there's definitely a very particular investment community when it comes to MLPs.
Gotcha, gotcha. And just final question, more of a summary question before we open the floor for questions. But, you know, given the volatility of shipping, marine transportation, given the volatility in energy, given the volatility in yield, I mean, are you guys happy with the decisions that you made to set yourself up as a yield instrument, yield vehicle, in terms of what's coming next, in terms of maybe, you know, maybe a more robust environment going forward? I mean, do you feel as though your decisions in the past have set you up in not an area of distress, but an area to be able to potentially prosper going forward?
For sure, and it's mainly for the reasons that we discussed earlier. The better valuation on average compared to C corps, the discipline, the fact that we have been able to tap markets when for many other shipping companies equity markets were closed. I think all that have been very important and have allowed us to grow. I mean, we have over the last 6 years we have raised about $750 million of equity or preferred equity. We have grown the business. We have solidified our balance sheet, and that has been definitely, I think, different to what some of the maritime C corps saw at the same time. Having said that, it is a model that is predicated on access to capital markets. The recent turmoil in MLPs meant that capital markets remain closed, and valuations as well as distributions, as well as in our case, had to be revisited in order to make sure that they adjust the new reality. But we do believe that the MLP market is showing signs of strength again, and it is the right structure going forward.
Are you better off for being an MLP?
Definitely think that this company is well structured in the MLP, because with it being a pipeline business, with it being, there's no spot market in shuttle tankers. There is no S&P in shuttle tankers. They are fixed contracts. They're long term. They're built for fields. Oil majors want to specify their own ships when they open a new field up, and they want certain bells and whistles on the ships. Although obviously shuttles are transferable, oil majors do have their own preferences. So genuinely look at it that way. There's no real need to be in as a C corp, because there's no general shipping activity in the traditional sense for us. So basically, yes, I think it's the right thing.
Excellent, thank you. And we have 1 minute for any available questions.
You have a question?
I had a question for Jerry. Jerry, you recently received some shares in Hyundai Marine in return for a contract restructuring. I was just interested to know whether you've sold those shares yet, and for how much.
Sure, and just for everybody's so that everybody understands better what we're talking about. One of our charterers, HMM, went through a restructuring, and it was an out-of-court restructuring and a relatively successful one, especially if one takes into account what happened to its compatriot Hanjin, which is seeking bankruptcy protection. So we ended up agreeing to 20% charter reduction, and our loss of revenues was compensated to us in the form of shares in HMM. We have recently disclosed that we have sold this loss of revenues. The nominal, let's say, value of those were $37 million, and we sold those shares for $29.7 million, so an 80% recovery.
Questions? All right, I think that does us. All right, thanks,
Thanks.
guys.